U.S. interest rates have risen faster and remain higher for longer than many commercial borrowers expected. Today, we're cutting through the macro noise to focus on what really matters for U.S. businesses with floating rate debt. How policy moves translate into borrowing costs, how market volatility shows up in cash flows, and what tools companies can use to manage that risk. Joining us to break it all down is Josh Cannington, VP of Interest Rate Derivatives at StoneX. Welcome, Josh, and thank you for joining us today.
Yeah, happy to be here.
So let's start with this. Can you walk us through how the Fed's decisions actually show up in the borrowing costs that U.S. businesses face?
Sure. Yeah, it's a pretty common misconception that the Fed controls all interest rates across the board, but that couldn't be further from the truth. All they can do, the Fed's tools are really limited. They can raise and lower the federal funds rate, or they can buy and sell bonds on their balance sheet. And when they're lowering or raising the federal funds rate, borrowers immediately see that in their floating rate debt, whether that's U.S. SOFR based, Euribor based, Cora, Sonia, you name it. Those floating benchmarks that borrowers use in their floating rate debt, the Fed and central banks can control that with a one-to-one immediate change in their borrowing costs. Now, further out, that's a completely different story. So long-term term rates, mortgages, anything that's fixed, by principle, those have no correlation to the Fed. There's some overlaps, of course, with Fed expectations and the forward curve. But that's where borrowers really get mixed up, is that, if the Fed is lowering rates, all rates will come down alongside those. And that's not necessarily the case. And we saw that back in 2024. The Fed lowered rates by 1%, but the 10-year Treasury went higher by 1%. So there are some nuances when we're talking about borrowing costs and what the Fed can and cannot control.
Most U.S. borrowers now hear SOFR instead of LIBOR. What exactly is SOFR, and what does it matter for their loans?
Sure, and that's a great question and a very common question that we get from clients. SOFR stands for the Secured Overnight Financing Rate, and it has essentially replaced what borrowers were accustomed to using in their floating rate loans, which was LIBOR. There's nuances between the two. For example, LIBOR was an overnight rate that banks reported where they can borrow amongst each other. SOFR is an overnight rate derived from the repo market, where secondary market participants can borrow. So again, yes, there's changes and nuances between LIBOR and SOFR, but what's important to borrowers with floating rate debt is that either one is essentially controlled by the Fed. When the Fed is lowering or raising rates, SOFR and LIBOR will go up in the same magnitude.
Okay, so when does it make more sense then for a borrower to lock in rates with a swap versus buying an interest rate cap?
That's the million-dollar question. Yeah, when you look at hedging floating rate debt and the solutions available to borrowers to manage that risk, I would say swaps are the really easy plug-and-play hedge. You're converting floating rate debt to fixed. Now you have budgetary certainty. Your hedge is in place. That's fine. A cap is more of a good solution for a borrower that has risk tolerance to the downside, but wants to protect against any rise in rates. So instead of looking for budgetary certainty, a borrower that just wants upside protection, hey, listen, I'm comfortable floating today. I just don't want any exposure to a rise from here. A cap makes perfect sense for that borrower because it limits the upside exposure for that floating rate loan.
Okay, but even with the right hedge in place, things don't always line up perfectly, right? So can you break down what basis risk is and why it can sometimes undermine a borrower's hedge strategy?
Sure. Yeah, so basis risk is just that there's a mismatch between what you're paying on your loan and what your hedge is going to return and protect against. So for example, if I'm a borrower and my loan, my bank has given me a term SOFR loan and I hedge with an overnight indexed compounding SOFR swap, let's say, that the difference in the nuances between those two SOFR indexes introduces volatility and uncertainty that's difficult to manage. So when there's basis risk, as they say, it's important to make sure all of that gets worked out before the hedge is in place, so you don't have that noise going down the road.
Understood. Josh, thank you again for joining us and for all that information. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.